Hey everybody, happy Sunday. It is May 15th. Blood moon, lunar eclipse. Summertime over here and we got torrential rains today and it is probably about in Fahrenheit about 78 degrees outside, which you don't even get in the winter over here. So, yep, climate is changing. Anyway, I'm going to go in here and I'm going to go from a wide view to a short view to a roundabout view, but really, I want to detail on here a couple of things that have hit me this week. And it's uh, a few traders that are trying too hard and have left. And guys leave, guys come, guys leave. It's all the same. This is a video of me when I was doing the 575-pound deadlifts about a year ago. I'm a power lifter. I don't have the six pack abs anymore. I don't go in there and do bicep curls for 2 hours in the gym. I do heavy compound workout weights. And here, my problem with this gym that I'm a member of, that I pay to be a member of, is they don't have enough weight for me to be able to put on the bar to do higher than that. So I'm limited. As you can see at the end of the barbells, I'm struggling. But hey, man, I lift heavier than 95% of the people I've ever been in a gym with in multiple gyms in multiple countries. And I'll be frank with you that when I go into a gym that I'm paying to be a member of and I see these kind of guys working out, I get intimidated. I get intimidated because these guys look fucking fantastic. Obviously, their entire job is to work out and diet and eat healthy. And this is a pre competition gym backstage prior to these guys going on stage and competing for fitness physiques. But like I'm saying, coming from me, showing you what I do, I see guys like this in the gym, I get intimidated. And I see that with a lot of traders that they get intimidated by other people making money and they're not. And most of the time it's because they're quiet, or most of the time it's because they're trying to make a mountain out of a couple of rocks and some cement. And you can't do that. You grow as you grow as you grow. But what I'm seeing a lot more of and getting comments of is, hey man, I learned a lot. I'm going to go ahead and use the membership to pay to put against my mortgage, and I'm going to go and try and do this on my own. This is what happens when you go and do your home gym at your own. I've done home gyms. I've done home gyms 3 times. In fact, my entire layout here that I've got for trading, my 3 big TV monitors, my 3 monitors on my desk, the 3 big monitors are held and welded on to a squat rack that I bought right when COVID hit because I was going to be working out at home because the gyms were closed. Well, now my squat rack is a TV rack. This is what happens when you go out on your own. You start looking for somebody out there who's just going to give you trade tips. You're not learning anything. You've got no motivation at all. And eventually what happens is you become that. You become a fat piece of shit who's completely fucking worthless for any other reason other than, to go and work and, provide a service for somebody else. This is coming from somebody who hasn't had to put on a suit, a shirt, a pair of pants, socks and shoes, whatever it is, for 17 years. I've not worked for anybody. So if you want to go out there and do it on your own, hey man, I wish you the best of luck. If you want to find somebody else that fits your niche that you're not intimidated with, or that can give you better views and angles of the broader stock market, or you simply just want somebody to tell you to buy this, sell that, and you don't give a shit about the market, you don't care, you just want to make money, go to the casino, bet on red and black. You got much better odds going that way. And I'm going to show you that as we go into the video here. But as we go, you know what? Before we switch off of this, I'm going to go straight into this. This is a chart of the SPX going back from Black Friday, 1987, to around 2012, 2013. And here on Black Friday, you had 5 afterwards. Not during, after. You had 5 consecutive down weeks. I've mentioned this before, how getting 5 is extremely rare. You got 5 during COVID. Here's July and August of 1990. You got 6. I didn't mention this last week when I posted out the images of the other times that it happened. And you had 5 here as well, back in 1997. So you see that from here in 1987, and then here in 1990, and then here in 1997, there were 3 times in 10 years that you had 5 consecutive down weeks. Nothing again until you got to the .com highs. And as you got to the .com highs, I'll go and zoom over here. Little mistake there with the mouse. Here. Here's your September 2020 or 2000 after the .com, which failed to make the top off. February of 2001, March 2001, you had a combination of 8 consecutive down weeks. Right here is 9/11, September 11, New York City, 2001. You can see here you had your dip, you recovered extremely well off of that, and then you came down here for your 2002 bottom. 2004, you had 6 consecutive weeks. Here's your 2007 all-time high, which just pierced through the .com high. Here's where interest rates were being cut at the same time. Here's July of 2008, you had 6. Nothing else during the entire decline down here to the 2009 lows. And then again here in May of 2011. I am such an idiot for not telling people that we were going to get a 6th consecutive down week this week, because it hadn't happened in more than 10 years. 5 is rare. 4 is almost explicitly as rare. And here it is, we got 6. Oh my God, Tim is an absolute fucking idiot. This is stupid. He's not making me any money. Well, you know what? I'm going to show you that as well as we go into this. This is where we're at, and I'm just again showing the same chart that I've shown before. Here's your 50.5% decline from the .coms, 57.69, absolute double bottom if you go in and zoom in on that. And I stress anybody who cares about how this market works from an algorithm point of view, go and look at how you broke below the 2002 lows over here in 2009. You won't believe your eyes when you start to see it. We had a 17% dip after that. We had a 21.5% dip off during that May 2011, which a lot of guys that I chart with, this is your 1, this is your 2, and this was your 3 as we came up here, right? You had a 14.48% dip when interest rates started to get raised by Janet Yellen in 2015. December 2015, she announced it. We had been plateauing for more than a year, right at that 21.34 level. We had a 14.5% dip. Crude oil went down to $26. Bam, there was your revolt. You had Brexit, your double bottom, Trump got elected, and you had your rally. Coming in here now to 2018 to now, which is a little bit more precise and a little bit more relevant, you had your 20% dip right here in October to December 2018. This is what we all have as our number 4 wave, intermediate 4, and here was your major 5. That was your 3. Here was your dip down here on number 4. This is your basically your major cycle primary 4. Here's your primary 4 lows, and this is primary 5 that we've been working on, which, again, like I've shown you on the other charts, September was where all of us have our 1. Down here in October is where we all have our 2. Up here in January 2002 is where we all have our 3. And right now we're making our 4. Our 4 has so far dipped 19.92%. Now what I want to do here is to zoom in to the year to date, right? Daily, year to date, and the time frame that I want. Well, I can't do that. So, you know what? 90 days. From the 90 days, I can go back over here to custom, and yes, that's what I want to see, and give me the 2 hour, and bam. We've got our 1, 2, here's our 3, right to the 223.6 extension into the January low. We had our 4 bounce there into February. right at that 45.90 level, if you remember, and then bam, Putin decided to invade over there, blah, blah, blah. You got your 41.15. You had your ABC rally, which is what we're all looking at as our second wave down. Zigzag 1, 2, 3, 4, 5, ABC. And here is your 1, 2, 3, 4, 5 that we're in right now. And I'm going to show you that as we come over here and go into April. And look at the exact 5 weeks, 6 weeks that this has been declining. These white lines that I have are Mondays. These are your Mondays, right? And I'm actually going to zoom back on this just a little bit more. 46.37. If you remember, I was telling everybody that this is a big bear B. It very well could be a big bear B, but no matter what, at that time, if you recall, back there in the end of March, we were scaling out of all of our calls and we were getting into puts. So the beginning of this decline has absolutely nothing to do with where we are today. The beginning of this decline, we were playing it on the short side. We knew we were coming down to that 43.85 level more or less, aggressively getting into the calls ahead of it. If you recall as well, 45.13, it's posted in the chat room, it's posted in the emails. That is your get out of calls zone. And if you want to get into puts, go ahead, but we need to see what this thing's going to do. And it actually turned and got very aggressive to the downside, as you remember. But what we had there was a 3.26% bounce. Come back down here after we got to that bottom there at 425. We had another 3.5% bounce. Again, here we are at that 43.09 level, which is going to continue to be what your major focus is moving forward into the month of June. You had your decline again down to 40.50, where we broke the February lows fractionally for a couple of minutes, and then bam, that's 6% within one full 24-hour period rally off of the FOMC meeting because Jerome Powell did not stress 0.75% rate hikes. That was the rally we got. And then the very next day, the bond market says you're full of shit, started to turn, and everything turned to the downside from there. Nobody made any comments about 0.75%. The market assumed he was going to go ahead and do it anyway. From that, we had the decline into the beginning of this week. This week that we just finished, we had our drop. And then again, when Powell was renominated to go for a second term as chairman, as it was posted there in the room, everybody saw his news, he made his comments. And the comments are in the chat room, which I'd have to look back at to see exactly what his words were. But there was something to the extent of, if inflation starts to decrease, we won't have to be as aggressive. And that's why we had our 4.6% rally over the last day and a half, going from the Thursday lows over there into Friday. And I want to go over this, okay? I want to go over this really, really stressfully to show you why I have been playing the call side very respectfully as I continue to post everywhere, rather than playing the downside considering where the VIX is. And here are two prime examples for you as to why. Okay. Here's your SPY last week. Okay. On Wednesday, right there, we topped out at 404.04 on Wednesday, which is relatively around, as you see, that 40.50 mark over on the SPX. Right there at that 404 is where we topped out mid-morning at around 10:45. Now, when we topped out right there, had you gone over and bought the SPY 400 calls, understanding that we had dropped down here to 396 a couple of times, and I want to show you this trend line when I zoom out in a little bit. If you had gone and bought the 400 puts, $4 out of the money for Friday, you would have paid $3.58 if you got the best price, $358 per contract. If you rode that all the way down to where that low level is, that bottom, you almost got 350%. 300, 400, the math is there. But yes, it was a trade to be taken, and I want you to see the risk. $358 to double, $358 to even triple. Now let me show you the other side of that. On Thursday, as you see there in the chat room, I was posting the 398 calls, and I posted it right around 10 o'clock in the morning. And here's your 10 o'clock in the morning pivot, right around there, right? So this is where I was posting the 398 calls. They are 394. They're $4 out of the money, and they were 89 cents. They dropped down here, or sorry, they were 56 cents. There was a 10,000 volume candle almost at the lows at 56. I'm wrong. I'm wrong again. I'm wrong again. I'm wrong again. When I posted it, I said they were under $1. And I remember M. Verich, guy that I've known for a few years, who finally decided to join us a couple months ago. M. Verich was in these, and he rode these to around $4. $1 risk for a $4 return. The same 300%. The same 300% that you would have got on the $358 risk over on the puts. Same exact thing that you got over here on the calls, with a lot more money, a lot less money on the table for the exact same kind of percentage return. This is what I talk about with respect, respectfully in it. We didn't close green, and I'm going to go through that as well as we go into here, because as you see during the course of that week, we did not close green. We could not break above that 40.50 level. We could not break above that 40.81. We did not get into that entire gap from last weekend, which is up above here, above 40.81. Well, yeah, back onto this. We started our decline 6 weeks, started here, April 4th. This is where the 6 weeks begin of this decline. We were down 1.41% for the week, 0.18% for the week, basically a doji candle. Then you had your aggressive weeks right there, 2.9, 2.6, which is where the FOMC meeting falls into. Week 2, last week. Sorry, going backwards. This was last week. This was this week. Here's your FOMC week, blah, blah, blah. We started out here. All in all, it's an 11.5% dip. We got down 19.92% from the all-time highs. We came down and kissed the 23.6 retracement to the 2000 lows, which I want to show you that on the SPY chart before I go into the SPX. And here, okay, you see this trend line, this blue trend line here. Right below that is your 20% mark. Right above that is your Fibonacci retracement to the 2002 lows, 384.89. We just came down within pennies of touching that. Now, I'll go here on the 1 minute chart, you don't see that. I'll come here on the 5 minute chart, you start to see that trend line show up. I'll zoom out here onto a 10-year. No, actually, I don't need it. I need a 5-year. Do I? 5 years or 10 years? Yeah, I think I need 10 years to get this. Okay, yeah, no, I don't. Here's your 2008 high. Here's your COVID high. There's your trend line. Everything lines up. Same thing like I was saying over there on the QQQ, how it came down and it kissed the minus 30% line. Right down to that minus 30% line, it kissed it, and all of a sudden we started to get a buy coming in. From here, what's curious and cautious at the same time is that we've got 3 waves, an A, B, and a C, just like we had here in 2018. We had an A wave down, a B wave up. Here's December, and then boom, there's your C wave. And you can see your C wave is very aggressive to the downside. We were minus 20% for 3 wicks. 3 1-minute candles, we wicked below 20% on December 24th and December 26th. And as you can see over here, it took until almost March to recover where this drop began. And it took well over until almost May of 2019 to get back over that October level. And this is again what I was talking about with that non aggressive move for the bounce to the upside when this correction is over. It's not going to be an absolute ramp up. In the beginning, it is, for without any shadow of a doubt, but it is going to be a bumpy road, and it's going to be a long road to get back up to those levels to where we came from. So again, that's on the SPY. That's one of the things that I wanted to show you was that trend line. But now I want to go over here on back onto the charts to get really into this, right? Here's your SPX, and what I'm looking at here, I'm looking at the yearly. This is exactly why we were getting short as we were going into the beginning of the year, is because we already knew that we were extremely overbought. Come down here onto the monthly, okay? And your monthly is obviously very aggressive to the downside. You can see here that, over the course of these months, starting back in August of last year, the divergence has been in place on the monthly. It's been in place, and now that it's been activated, it's obviously taken a trend to the downside. You have not been aggressively oversold since 2011 or 2011, and again here in 2009, down to those low levels like you were over here in COVID, and we're coming extremely close to where we already were when we got there in December of 2018. I'll go over here onto the weekly and show you here. The weekly has broken below the oversold warning levels exactly as it had during COVID and exactly as it had in October of 2018, which I will point out and make very stressed. October of 2018 was obviously not the bottom. You had a higher low in December, and that was where we got our buy divergence, and why I sat there alone during Christmas while everybody was opening presents, banging the table, telling everybody to buy everything that they possibly could, the same way that I've been doing over the past week plus, when I was looking at the bottom already being in. And I'll show you here why I thought my bottom was already in. And that's exactly where we come from here. Here is the daily. Okay, you can see obviously when you came over here on COVID, you had an aggressive breakdown to virtually pennies. We were down below 5 on the RSI on the readings. Over here in October of 2020, we were aggressively oversold down into the 15 levels. You didn't get oversold like that until you got back over here in September and October of 2021. You had a little bit of a dip over here, but it was nothing back in June because everything was cruising. We were having nice volatility all during 2021. We were getting 4% runs to the upside, 2, 3, 4% dips to the downside, never going much greater than 5%, playing both sides of the table, and it was absolutely a fantastic year, 2021. But then you come over here into January of 2022 and zoom in here, and you can see how you got aggressively oversold on that. And again, why we were out of our puts in January and into calls for the bounce. 45.95, we had our warning level. Didn't work out for OPEX in February, didn't work out for OPEX in January. March worked out only because it just came out of nowhere and got aggressive to the upside as we were breaking through onto OPEX back into March, if you remember that. And then here we are in April, and April, complete breakdown. Now we're in May. May OPEX is this week. I have zero confidence in it whatsoever that we're going to be able to break up above those levels that we need to, which are, come back over here, 41.30. We would need to break up above 41.30 this week for OPEX to work out and post in the OPEX pattern, which is a higher high for the month. And no, actually, I'm wrong. We would need to break above 43.07 this week for the OPEX pattern to work. And the OPEX pattern has basically been wiped off the table for now. I've got no confidence in 43.07 showing up this week. If it does, fantastic. I'll entertain it. I'll give it a pat on the back. I'll buy it a sandwich. But I am not going to be sitting there like I did last week, buying one call at 4,300, buying two calls at 4,200, expecting this to be a return, and then have Fed Mester, the wannabe lady boy with the black nail polish, come out and say, oh no, we'll do 1 point hikes because we got Fed Bullard coming out on Tuesday. Bullard is as bad as fucking Mester. So whatever he can come out with and say on Tuesday, I don't have any bit of confidence that we're going to get a 300-point rally this week. If we do, fantastic. But I'm not going to go out there and play that. And again, this is where we are when I came down here in April saying the bottom is in. The bottom is in. Because I saw that I had my daily oversold. I knew we were going to get a bounce to the upside. That's what we got on the FOMC. And then they came down and they slammed it down. And now what you see over here is fantastically a buy divergence on the daily. Will it break out? Will it break above the EMA? That's what we need to see, and that's what we need to see it get above those levels that I've already explained, which are all from this past week. You need to get above 40.50. You need to get above 40.69. You need to get above 40.80, and then you got to get into the weekend gap. The weekend gap, 41.23. That's what we're going to be looking at when we get into there. Here's the NDX, and the NASDAQ, even more aggressively, has had this running buy divergence on the daily as it has sold off since February. Running buy divergence since the January lows. And nothing coming in to save it. Nothing. Came down, got all the way to your minus 30% line. You had support right here, which is your Fibonacci retracement to the 2002 lows. And you can see here, this was fantastic. Right here, you were holding it. And then all of a sudden last week, it was a complete, absolute rug pull breakdown. Bam. You got the 161 extension on this 123. Possibly, very possibly completed wave 5 as you came down, touched that minus 30% line. But we're going to need to see some follow through, and I'm going to cover that going back to the previous 6 consecutive down weeks that haven't happened in more than 10 years and try and look at a trend that came off of those in order to kind of look at where we are right now. Come over here back to the NDX and onto the weekly, and you can see here on the weekly, nope, no buy divergence, extremely oversold weekly, as oversold as you were over here in 2018. Right over here, I don't look at double bottoms when I'm looking at the RSIs, but as you can see here, excuse me, apologize. You are aggressively oversold here on the NASDAQ. For all intents and purposes, this is looking for some form, some fashion of a catalyst in order to go ahead and take it right back up and come back over here and go here to 2000. Yep. And go on the weekly and yep. And that line right there, that 12996 that I was showing was support. That's where it comes from. Comes right there off the 2002 lows. And as you can see here, the 2009 was a higher low. That's why we don't use it. Bam, 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 bam. But anyway, again, same conversation that we're having. This is very obviously a aggressive sell down that has taken place. A big bottom for a major, wider out run to the upside, and why I have been pounding the table for anybody with a 401k and an IRA to be distributing as much as they possibly can into the position of these good names, the AMDs, the NVIDIAs, the Apples. I'm not that big of a fan of Facebook anymore. You've got upside on Microsoft. Amazon, definitely see upside of about 30%, even 50%. Tesla, same thing. You got 500 points plus to the upside over there on Tesla. All the other stuff, your nitty picky Home Depots, UPSs, ARC, I don't see the stability and safety to the upside as I do with your major liquidity names that I'm going to go over as well in a little bit. The VIX, right to 2884. Right to 2884 on Friday. You don't break that intraday. I've said that 100 times. These major lines get broken overnight. And as of right now, with the 2884, with everything coming here for the 1 hour, hang on. excuse me, with everything coming over here on the 1 hour being oversold, I have to agree with what Weekend Wall Street's showing. Weekend Wall Street right now is showing that the Dow's going to open up down 36 points, showing that the NASDAQ is going to open up down 22 points. That's right now. Okay? You refresh it, yeah, same thing. It's not something that's 100% accurate, but it is something good to go and get judged on. But go back here to the video and go back here to, I'll just look at the 20-year, right? Here's July 2004, where you had 6 consecutive down weeks. Excuse me. The next week, nothing, a lower low right after that, and then you made your move to the upside. This was not a sell-off, this was a dip. July 2008, you could almost go and say and have an argument that this is exactly where we are right now. Go outside. See how long you're waiting in line when you go to a restaurant. See how, go to the mall, see what people are buying. This isn't 2008. Sorry, it's not. 6 consecutive down weeks, had a flat week, little bit of a grind to the upside, failing to break out, and then boom, obviously breaking down even further because this is when the mortgage crisis was taking place. And then again, the last time that this happened, May of 2011, you had your 6 weeks to the downside, you had a flat doji, another doji, and then bam, ramped right back up to the upside and then slammed it down even harder. So using these trends of what happened before, you have to obviously continue to be respectful. You can see after the slam came down, this here is 30% from the all-time highs. This is not the all-time highs, okay? It's not the all-time highs right there. But this gives you an idea of where you are in the bounce, in the recovery. This would basically put you at about May of 2020 after the COVID low, if you were to look at this as COVID, and here was your recovery taking place. So again, you know, we're not into that level as of now, but that's basically what we're looking at right here, that because of the way that this has been 3 waves down, we can't say that this is complete, that we're not going to get a full 5 waves down. When we get up into this level here, the 4100s, we can start to, you know, reassess what everything looks like. When we break above 4309, we can again reassess what everything looks like. But again, breaking up above 45.45 and staying above 45 will 150% eliminate this bear market correction dip completely. So that's where we're at right now. And quickly to let you go, you know, this is why I keep track of the SPX. Literally, like I've shown before, go over, make your spreadsheet. This is the data that I want to use, that I want to trade off of. You know, I've blacked out my Fridays because Fridays have been complete shit. The ranges are still very aggressive, 100, 120, 89, 75 on Friday. We've got big rate, really big ranges. And you come over, which I'm going to highlight here also, you come over and you look at your SPX and like here's Monday. Monday is looking at a 65 points up or down. You've got 74 points on Friday, and the last 5 days have been 103 points. So again, using that, knowing that you're getting 100, 103 point range for the most part on average for the last 5 days, this is only pricing in 65 points. What I would be looking at then would be 30 points above that 65 points from wherever we are, and at the same time using the other charts and the other technical setups that we have in order to pick the strikes, because what we have now is in the chat, we have a SPX spreads channel, because we're going to be having SPX every single day now. Monday, Tuesday, Wednesday, Thursday, Friday. This week is the first Thursday, so we now have SPX every single day of the week. Every day of the week. I've opened a new account and I'm going to put $8,000 into it. And on that 8 grand, I'm specifically going to do SPX spreads only. And I'm only looking to get $200, $200, $300 on every spread. Break even is break even. Starts to go against me, I'm not going into the roll. I'm not going into the greed of rolling to the other side. Even if it does look like it can go ahead and move, you can get out of the trade, go get into another one. Cost you a day trade, okay, that's it, don't trade. But that's where we're going to be going here is every morning, right when we get to the open, or whenever the setup is there, I'm going to be posting the trades here on the SPX spreads, just like I did in the alert room, which you see here from Friday. Here, SPX credit. Sell the 39.30 puts, buy the 39.20 puts, $240 credit. We closed at, where did we close? 4,000 what? Yeah, so obviously full credit. So yeah, that's going to be one of the things that's going to be there. We're going to be doing that from now on. And again, just going over here, looking at the Fang. Here's Fang, right? And this is taking your highly liquid Fang stocks, your 10 bis Fang stocks. And you look down here, you hit your 200 moving average on the weekly, right? 200 moving average on the weekly, getting oversold here on the RSI on the weekly. Stochastics are starting to put in a buy divergence on the weekly. Your MACD is your MACD. That's your moving averages. It's always going to be like that. But yeah, and you're coming close to a kiss over here on your moving average on the Fang. So again, coming down here on the 200-day moving average, on the 200 weekly moving average on the Fang Plus, you got to start thinking that a bottom came in. Here's the Dow. The Dow just coming over there and closing right at the 100 moving average on the weekly. Stochastics, no buy divergence on the stochastics. Money flow still liquidating as it had since 2021. And you've got your little bit of a roll off top, but you've got your 6 consecutive weeks over here as well. Come over onto the IWM, you've got the same thing. You don't really have a completely aggressive oversold level when you come over here onto the RSI on the weekly because you're looking at a wide time frame. You're looking at 14 weeks. But you are right here, right at the 200 moving average on the weekly at 172.70. And if you zoom out, you can kind of see a plateau right across that 165 area, 168. Starting to get a little curl up on your stochastics. Set up that it could very well be ready to get a major bounce. And here's the NYA, which is exactly similar to the Russell. It's a very broad spectrum of stocks. I've got a dry throat here. Hang on. Dry throat from all this. 100 weekly moving average right here is where you closed. Again, not as aggressive as you're seeing over there on the NASDAQ. Your NASDAQ is where your meat and potatoes are. Your NASDAQ is always where your meat and potatoes are. And again, using last week's data alone, last week's levels are where we need to break up above in order to start saying that this is starting to get recovered. Last and not least, the Dow Transports. Dow Transports, not even close to an aggressive sell down, even though they are down 20% from their all-time highs. Right here on the 100 moving average, just closed up above that. Again, it's a situation that we're in right now where, if you want to be one of these guys, you're going to need to put in your time and effort, not only in the gym, but in your education. And in your education, it's not just in your technical and broad aspects of what the market does, but in your button pushing, where your risk is managed responsibly. If you're going to ride a trade for the ride, then you need to be in the trade the right way. If, again, using this as just an example, these guys didn't go to the gym and wind up looking like that. It took them years to develop that. And as you're getting into your development in your first few years, you've got a small account. Take it more for an education where in your first couple of years, if you've got a little bit of green, but you're gaining the knowledge, it's fantastic. If you look at it that you're spinning your wheels, just instead of putting money into the market, donate your time like as a Walmart greeter, or go to Costco, and be a greeter, or you can even be a security guard if somebody's trying to steal meat. Um, but for whatever you do, just do it. I wasn't able to do this until I got started. And again, for me, it was personal motivation that I did it. I did it on my own. I did it because I wanted to. I didn't do this because other guys were doing it. I wanted to bend the bar. I wanted to bend the bar. And as you can see, when I start lifting this, that barbell starts bending. That to me is exactly why I was started doing that. And what I got out of it as my benefit was I got the strength. I got the strength. I got the stamina. And because of that, I got a little bit of muscles. But don't be this guy. Don't be this guy, because this guy, he ain't gonna help anybody. I'll see you guys in the chat.